Hello, everybody. I'm Gav Blacksburg, CEO at Wolf, and today I have the pleasure of bringing you some valuable information from the one and only Hamid. We've done a lot of different live shows together, but we don't often get to sit down in podcast format and really dig into your brain and understand how you have been so successful in the world of entrepreneurship and really investing as well. I know because you talk about it, right? You are not investing at a low scale. There's a lot of people that are putting $1,000, $2,000 in. That is not what you are doing, investing in the millions here and really shooting for 10x's. And we were talking the other day, someone said, hey, maybe you should talk about shooting for 100x's. You're like, I don't know if I've had 100x, but I've had a lot of 10x's. And that's just a
Right.
crazy thing to say because most people, maybe they've had one ever, maybe two, right? If they sat there, they held Tesla for several years, they held Nvidia for several years, but you've been able to repeatedly achieve this. And so there has to be, I know, some kind of process that you are utilizing and some thought process that you're putting into effect. And I want to draw that out of you to the viewers today and give them the golden mindset here that it takes to achieve 10x investing. So Hamid, welcome to the pod.
Thank you. Thank you. I like being called the golden mindset. There, let's set the bar up really high to disappoint everyone.
The Midas touch, one might say. All right,
That's funny.
so let's talk about it. Can you give people just a little bit of background as to kind of what shaped you as an investor and an operator today?
My background is largely entrepreneurship in the field of tech and software specifically. I've built a handful of different software products that have each achieved some level of success. I would say like $1 million plus of revenue success or positive cash flow success. Um, I think I've built five different products or maybe six different products now that have achieved that level of success. And um, so I've been in the business world and trying to build products and companies for all of my adult life, basically. And I've failed at a bunch of them as well. So there's been lots of products that I've built that have failed, and you learn from the failures just as you learn from the mistake or from the successes. And that has probably helped shape what how I view companies and how I view um, investment opportunities as well, where I'm looking at it from the lens of an entrepreneur. As an entrepreneur, would I want to own this company? Is often the question that I ask,
Mm.
and sometimes the answer is yes because it's so well run. There's such a huge opportunity in the market. It's at a reasonable price. Sometimes it's like, well, the maybe the company has already matured, maybe it's flatlined, but like the price is ridiculous. And there could be other reasons for it as well. Maybe the future is so bright and great that I think that the market for this particular field is going to explode, and this company is in the center of it. And even if they don't have the revenues and profits today, maybe they will in the future. So those are the sort of three different categories or buckets of investments that I tend to make.
Would you say that you're a fundamental investor at heart, or do you think that there's more to it since that you're approaching some of these companies that maybe don't have the fundamentals but have more of the story?
I mean, it's a combination of fundamentals and story. So, like it will always be around fundamentals for me, but it's fundamentals when, right? And sometimes it's about the fundamentals that you project in the future. Sometimes it's about the fundamentals today, and sometimes it's relative as well. So if you like a particular industry or market, but some company that is growing at I don't know, let's say 15% is getting traded at a certain price earnings ratio, and another company that's growing at 20-25% that's arguably equally as good is trading at a lower price earnings ratio, then relative to A, B might be a better investment, right? And sometimes that's how I look at it. And I have some of those investments that we can talk about today as well, like Google and Meta fall into that category, for example.
Yeah, I definitely want to dive into some of the specific pieces here. Just kind of two quick questions before that. One is there a mindset difference when looking at a 2 to 3x investment versus a 10x investment, or is it kind of just a different level of conviction, a different level of time length, or is there a complete difference when searching for those types of investments?
So sometimes it's First of all, it's a lot easier to identify investments that might double or triple over the next 5 years than it is opportunities that might 10x over the next 10 years. But being able to ask the question, can this company 10x over 10 years, is a reasonable question to ask, especially on smaller companies that you're potentially considering for investment or that I consider for investment. Um, I wouldn't say it's a different mindset. I mean, it's a similar mindset, but the risk level typically on things that can 10x is a lot higher than things that might only have 2x or 3x opportunity over the course of 4 or 5 years. But this sort of long term mentality is always the framing in which I do the investments from.
Got it. And then where do you think that true asymmetric upside actually comes from?
Where does it come from? Well, I think it's simple math, right? Like if the probability of something going to zero, is let's say 50%, which it rarely ever is. I don't think I've ever bought anything that has gone to zero or like actual zero. Um,
No Enron?
Maybe yeah, no Enron. But if the probability of it going to zero is 50%, the upside potential of like the other 50% is oftentimes multiple times its current price point. Sometimes you might be in a stock that might try to trade sideways for a long time, like very mature companies tend to trade sideways. um, if I was in AT&T during a time when I was using it as a cash alternative, as a dividend stock, for example, for a couple of years between 2020 and 2022. But AT&T, for the most part, traded sideways. Even taking into consideration the dividend yield, it was like net barely positive over the course of a couple of years. But a company like AT&T is also not going out of business. It's not going to go down, 60, 70%. That's just highly unlikely, or certainly not going to zero. Um, but the upside potential is a lot lower. But on some higher risk opportunities where the company is rapidly growing, it has demonstrated that it's capable of executing, um, but um, but it's still not profitable. The downside is potentially zero, but the upside on a fast growing company might be 5x or 10x. Uh, and if the probability, and it's hard to estimate these probabilities, but if you say like, I don't know, they have a 50-50 shot of making it, well, that's not a bad thing, right? If the upside is 10 times returns, but the downside is one time of losses, the 100% of loss, well, you should take that bet every single time if it's truly 50-50, right? Um,
Right.
so that's also an angle by which I look at potential risky investments.
So let's go into some of the most successful investments that you've made. And I really want to start with, how you identified early on potential for massive upside.
Yeah, I mean, there have been numerous ones, but the ones that I remember over the, let's say, last 10 or 12 years, um, it probably one of the biggest ones I remember is Netflix. Netflix in 2012, 2013 timeframe, it announced it was a high flying stock for a long time. Since it became public, it was trading at what I would have considered overvalued. I love the company. I used their products. So I was a customer, and I love being a customer of a company that I invest in because it gives me sort of firsthand view into the company. But when they announced that they were splitting off their DVD business, for whatever reason, the market and Wall Street decided to downgrade Netflix left and right, and the stock crashed literally 70% almost overnight. And we're talking in the course of weeks or months. Um, and a stock that I considered very overvalued prior, all of a sudden felt like it was appropriately valued, and I started buying it. And even after I started buying it, the stock continued to collapse. And I think at the time, this is way pre split adjusted. Today, Netflix is roughly 100 times what it was in 2012-13 timeframe. So it has
Wow.
gone up 100 times since then. But when I started buying it, the stock collapsed by another 50% or so, and I thought, wow, like this could be a disaster because I just kept buying more of it as it went down because I was convinced that Netflix is not going anywhere, and they haven't yet penetrated everyone in the U.S. even, and there's an international opportunity. So that bet turned out to be correct, meaning that the separation of their DVD business, which they retracted because the market was so sour on it within a couple of months, it didn't do anything to the core of the business. The business continued to be healthy. They just kept adding more and more subscribers, and sure enough, after a few quarters, it recovered and passed its previous highs. So that ended up being an investment where from my lowest price to the highest price that I sold my last shares at was roughly a 25x, maybe even higher return. My average was somewhere around 7 or 8 times return on that investment. So that was one example. Uh, Facebook was another company where I was a user. It went public at $40 a share. It was a high flyer, but over the course of the next 6 months, the market soured on it. The stock price went below 20, less than half, and all of a sudden, you could, as a public investor, you could buy this company for lower than the last rounds of private investment. And
Mm.
this type of scenario happens over and over again. It happened with Robinhood when it went public. It went public at around $40 a share, skyrocketed to over 80, and within a day, and then all of a sudden it started to collapse. And I started buying Robinhood when it collapsed down to 15. And after I bought it, it went much further down, all the way down
Yeah.
to sevens. And again, I kept buying it, and I was like, all the fundamentals are great. The company is growing. It's not yet profitable, but it's clear. It has a clear path to profitability. So and sure enough, Robinhood has ended up being one of these investments that has skyrocketed, right? Over the past couple of years, it has roughly 15x from
Yeah, at
its
least.
lows. So yeah, maybe even 20x from its lows.
So a couple of good examples there. I want to just dig a little bit deeper in. So something like, Robinhood you've mentioned there, that's been a pretty big winner. And like you said, they weren't profitable at the time, but you saw the pathway for them to become profitable, for them to scale. What were some of those early signs that you were digging into? Because I know when we would talk on spaces, you would mention the cash position, right? And the
Right.
cash position was like, hey, like this is not going to go lower, this is a fair value. But the cash position is not an argument for this is going to 20x.
No,
So,
no, it's
so like,
not.
what is,
But
yeah,
but it helped de-risk. So, for example, Robinhood was trading, at its lows. At one point, it was trading below the amount of cash that it had. It's almost as if you could get the entire company products revenue for free if you had enough money to buy the whole company, because you would get that money in cash in their bank account, and you'd
right.
get the company, right? Like if you could actually buy the whole thing at $7 a share at the time. They actually had $7 a share in cash at one point, and I think they dipped below $7 at one point in 2022 as well. So from my standpoint, and they were, at the time, to the naysayers, the naysayers argument was that they're still bleeding money. Every quarter they're losing 400 or $500 million, so they're going to run out of cash. But my argument was that even if they continue to burn $500 million for the next several quarters, it will take 10 quarters for them to run out of money, because, or actually at the time, I think they had 7 billion in cash.
Or
So
12.
it would take them 14 quarters for them to run out of money. That's a lot of years to figure out and solve the problems and reduce your cash burn. And sometimes the market views things as if they're never going to solve any of their problems, right? And of course, Robinhood did solve their cash burn problem. They reduced their staff by 30%. They continued to build their products. They continued to increase revenues. And that was playing out quarter after quarter, and the market was sort of ignoring it. And when you just projected the trajectory of, if revenue continues to grow, and cash burn continues to reduce, then obviously they're not going to run out of cash, and they're going to be a profitable company. So, um, that is currently playing out with Rivian, right? They're in a cash burn situation where every quarter they're burning cash, but they have $7 billion of cash. The naysayers are like, no, Rivian's going out of business. Well, okay, assuming they burn the same amount of cash as they are today,
Right.
and they never stop that. and they never add additional cash, sure, they'll go out of business. How long will that take? It'll take 2 years because they're burning about $1 billion a quarter, but they have 7 billion. So at a minimum, they're going to be around for the next 2 years to see things through, right? Um, and if you just look at their sort of uh, uh, planned release of the R2, then all of a sudden you can kind of see these glimpses of hope that, well, maybe their cash burn is going to reduce over the next couple of years, and it means they keep adding additional quarters of longevity, and they don't have to solve the problems necessarily in the exact time frame of the current trajectory of cash. Plus, there's opportunities for them to raise more money down the road as they achieve more success and their next vehicle becomes a hit and their autonomy capabilities come out, and some of those things come to fruition. So there's definitely risk there. The company is not profitable, but if it does achieve its goals, then all of a sudden the opportunity is enormous because the market is considering Rivian as not able to achieve the goals that it has set out for itself.
So if you're talking to a beginner investor, right, and they can and they're just saying like, hey, I want to build out my process of how I do research. And I know it's not just the first investment, right? Because you're constantly adding, trimming, you're going and talking to the Rivian CEO and asking them questions, right? Like someone says, I want to be like Hamid. I want to invest like Hamid, And you say, okay, here's the game plan. It's hard work, but this is what you have to do. What does that look like?
Yeah, and first of all, hard work is building a real company. That's hard work. Investing is not hard work. You do basically
I'm like an
nothing.
entrepreneur. Yeah.
Building products it has a totally different level of personal satisfaction and the level of work required. That's like actual hard work. Whereas investing, you're just putting money down now and being patient and taking more money out later if this investment is a success. And you have nothing to do with it, by the way. You have literally zero to do with whether or not that investment it goes up or goes down. So in neither direction can you take credit for or be blamed for its failure, right? Credit for its success or failure or take blame for its failure. Robinhood having 20x'd over the past couple of years, I can't take credit for its success. Well, sure, I had some money in there, and that money is a significantly greater today than it was. But it doesn't have the same level of satisfaction as building something. But in terms of how can somebody think in the same ways that I think is, well, to me, what matters a lot is like, what is do I like the company's products? And if I like the company's products, fantastic, then that's a great start. Then do I like the direction of the company? And the direction of the company and strategy of the company is generally top down, right? Like it all rolls down from the CEO. And I tend to like founder run companies because founder run companies tend to be focused on the long term as opposed to short term. A lot of short non founder CEOs are worried about their own pay packages and the short term stock price, because if they hit certain milestones, they can get an extra bonus, or maybe their stock can be worth some additional dollars. Whereas founders generally don't care about that. They have such a long-term perspective because what they're building is a company that is uh, uh, that is true. A, they don't want to necessarily sell the company, and B, the true value of what they're going to have is what the company is going to be 5 years, 10 years, 20 years from now. So founder run companies generally are what I gravitate towards. And then I watch interviews with the founder. I want to understand how the founder thinks, or am I impressed by the founder? Uh, are they executing on the strategy in the ways that I think they should? And those are the companies that really excite me. So uh, and and then and then the third thing, of course, is the valuation of the company. If a company is trading at 100 times revenues today, even if it's growing relatively fast, but if it's mature and trading at 100 times revenues, that's a company that has done a significant amount of its rise, if you will, the stock or investment rise in its history. And that is less exciting to me than a company that is trading at a small multiple of its revenues and most of its potential is in its future. So that's the perspective I have. Unfortunately, investors tend to get excited about the reverse, meaning if a company has 10x in the past year, that's when investors get excited about it. And for me, that's like when I
Momentum.
get the least amount. I go the reverse. It's like, well, it's already 10x. Now it's not undervalued anymore.
That's
So,
fair.
th-
You said the investing's not difficult, you just have to have patience. Well, I will say,
that,
I think people find it very difficult to have patience. So, how
yeah.
do you kind of rewire your brain a little bit to say, yeah, it's up, 5x, and I could take some profit here, but I'm patient because I see the long-term vision. Like, what is going on inside your brain? What's actionable steps people could take on a weekly basis?
Yeah, so patience is the toughest part, and of course, I'm still impatient. And as things go up, I do sell. I trim my positions. I have trimmed, for example, Robinhood or Rocket Lab, as these stocks have 10x and gone up higher. And I think it is smart to de-risk to some degree by trimming, um, but also patience is even more important when the stock hasn't gone up, right? Like uh, I've been in Rivian for almost 2 years, maybe, and the stock has, for the most part, traded flat. Only in the past couple months has it actually started to move. So during those 2 years, it's pretty painful to hold on to a stock that has either gone down or has traded flat. Uh, and I think patience can come with long-term success, meaning as you have done this several times before and that patience has paid off, then you tend to be more patient as an investor, as opposed to your first time investing. You invest in something and then it's down 40%, and after a year you're like, screw this, I'm out, right? So, or at least I'm out of this particular stock, I'm going to go to something else. So having that conviction and revisiting that conviction, is the conviction still valid? Has anything changed that would lower your conviction? Is an important thing. So I do that spot check to see whether or not I have the same level of conviction or lower, and I adjust accordingly.
So interestingly enough, I was just talking with Brian Feroldi, who you may be familiar with, strong
Yeah,
long-term investor,
smart. Yeah,
and works together with
smart
Brian
guy.
Stokel. And he actually, I asked him for a couple of examples of when you were right, when you were wrong, and when you were right, he actually gave the same Netflix example. So he's
Yeah,
been holding Netflix for 13 years, through all these different pieces. And then for one that he was wrong, he said like Grubhub. He said Grubhub came out and it looked like, hey, they are going to have this monopoly. They're going to be able to, but then DoorDash came along and then Uber Eats and Grubhub became a loser. Do you have any of those examples where it was like, I thought this was a winner. It ended up not being. I realized, and here's what I did about it.
yeah. There's one big one that I was investing heavily in that ended up being a dud, essentially, and the company has struggled and may have even gone to zero. I got out before it got to zero, but that company is Arcimoto. They create a three-wheeled, uh, kind of like a motorcycle, but EV version with a cabin that could have been used for like deliveries and things. I got very excited about this company around 21, 22 timeframe. I think maybe it was 2022. And the mistake that I made with that one is that I didn't realize uh, how distracted the CEO was, and it was a founder CEO run company. But when they not having delivered on their sort of main product that everybody was excited about, they branched off to add an additional electric bike. That should have been the immediate clue. And I was like very sour on it. I was very public and talked about how I think this is a major distraction for a company that is not yet profitable. Um, they the CEO's focus seemed to have shifted to this other product, and that was an indication. And I started trimming my position, but I didn't completely sell. And of course, it took them a few more quarters, but they ended up running out of money. They were burning at a high rate. That and not delivering on the promises that they were making. So the combination of factors over time is what caused that company to to really struggle. And it was basically, in my view, it was sort of mismanaged, um, but it's also a very, very tough market. The EV market in particular is very tough. Not many people have built successful companies. Tesla has been the only one that has been successful. I think Rivian has a good shot of being successful, but Arcimoto was one that did not make it. And I ended up at that time transitioning my Arcimoto shares when it was roughly around $8 a share from Arcimoto to Robinhood because I felt like that was a
Mm,
much better investment. And in that particular investment, I think I lost somewhere around 60 to 70% of my investment. But then, obviously, on the most of the investments that I make have asymmetrical opportunities, meaning I lost 60, 70% on Arcimoto, but ended up making many times my investments in Robinhood. So it has made up for it. But there haven't been uh, too many significant negative outcomes for the investments I've made. There have been some that have gone sideways for some period of time. Some expected to go sideways. Like when I made an investment in AT&T, I was not expecting that to skyrocket. Mainly, I was expecting it to be a cash alternative as a dividend stock, basically. But I ended up also exiting out of that position over time as I found better opportunities. And then when
got it.
interest rates went up, it didn't make sense to have dividend stocks at all. So it's like on cash with zero risk, you can get 3-4% interest. So it doesn't make sense to have a dividend stock.
Yeah, yeah, that makes a lot of sense. Well, I want to keep this, somewhat evergreen so people can view it at any time period, and I'll try to do that. One thing that is cool about your style of investing is that you're very public with it, right? And that anybody can pretty much go and see your portfolio in real time and have a great understanding of what you're holding and really why you're holding it as well. I think that's something that you've continued to really impress upon people. So, obviously you've created platforms around that. Was it inspired by, hey, like I've had so much success in my investing, I want to show other people how to do this? Like what was kind of the driving motivation factor there?
Yeah, I mean, basically, as you might be able to tell, I love talking about investments and stocks and companies in general. And that would be an often topic of conversation at dinner or with my siblings or friends. And between 2015 and 2020, I think I was causing everyone to go mad because of how much I talked about Tesla as a incredible investment opportunity that I felt like was severely undervalued. And um, what people didn't know is whether or not when there was negative news on Tesla and there's like fires being reported, there's all kinds of negative stories in that time frame around Tesla. And the stock would crash. Am I buying more or am I like losing my confidence in Tesla and selling my shares? And until the next time we would have a dinner conversation with that friend or sibling or whatever. And I always thought that it was weird that like there's no way to sort of share your investments with other people. It would be great if people could see what I'm invested in and even get notifications of when I buy or sell something. I really wanted something to share my investments with my siblings more than anybody. So I actually looked for a product that does that. I couldn't find anything. And then I was like, well, maybe there's an opportunity here. And then if there's investment influencers out there that have huge followings on X or on YouTube where they're creating investment videos, those people could use the platform to share their portfolios with others and allow them to follow their portfolios and see the performance of their portfolios verified by a third party in terms of what the actual performance is, as opposed to um, just telling people that, oh yeah, I've done really well. That was another thing that would happen is that when I would tell people for the past 20 years I have averaged 30% annualized returns, literally almost zero people believed me because people who understood what that meant would be like, if that was true, you would be in the top 1% of actual money managers in Wall Street. Why are you, like, why are you not doing that? Right? Like,
Why
and I
why
was like,
aren't you why
well,
aren't you doing that?
Well, I was building companies and software products. I wasn't in finance, and I wasn't trying to get a job in that field, right?
Yeah,
And now I have my own money to invest in,
there
and
you go.
uh, yeah.
Well, let's
So
take a look actually for a second while you're talking about it. We can look at your
yeah,
portfolio,
go
which
for
I
it.
think would be interesting here. And this is a snapshot in time. And I encourage people, if you want to see a little bit deeper, and see it in real time, you can go into here and actually look at it. But this is tracked, 500% since you started this, so not too shabby. 63% CAGR right here, and on a year to date, a lot of people year to date, their portfolio looks like this. And then April, happens wherever, April's back here, down, and then over here, and then kind of back down to like over here, like 25, 30%. But your portfolio stopped here and then has actually gone back up, and you're still up, 70, 86 percent year to date on here, and that's probably driven by having a large cash position. And actually, I noticed it could have been even better. I wanted to ask you because sometimes it's like, do you look back and you're like, man, like I should have held some even longer, because you had a really strong inclination that we talked about with AEO, American Eagle Outfitters, and you had a 48% gain there. I noticed, right after you sold on the 21st, AEO basically went nuclear since then and went up 52% since then. So like, how do you kind of think about like, oh, like I moved out of that into cash. Did you ever think about getting back in at any point? Just kind of like your thought process there.
Yeah, so American Eagle is outside of my wheelhouse of where I normally invest in. You can kind of see most of my investments are tech focused or heavily in tech, basically. American Eagle is in retail, and when it caught my attention was the Sydney Sweeney ad, where everybody was basically talking about it. Both people who loved the ad and both people who thought American Eagle is basically a company created by Hitler. So um, when I researched the company and I was like, this Sydney Sweeney ad is getting so much attention that it's now getting billions of dollars worth of free impressions. Essentially, this is an
Right.
incredible ad campaign. Um, and then the question was for me, well, is the company legit racist company? Are they like, are they literally the incarnation of Hitler, which is what's some people were
Yeah.
trying to make it seem like. Well, I mean, the reality was that the company's CEO and 30-year CEO who's bought the company is a Jewish guy who has been in the garment industry for a long time. I mean, it just did not sort of fit the story that like this is a very racist, Nazi-like company. And the ad just seemed kind of innocent fun, and Sydney Sweeney is like, I mean, clearly a lot of people are
Yeah.
huge fans. So I figured the ad was probably going to be a net positive for them, and they're probably going to be doing well. Then when I looked at the fundamentals, it was trading at roughly a price earnings ratio of 10, which, by the way, I did not know is pretty common for the retail industry. That's a very low price earnings ratio. So these companies are generating huge amounts of profit. They're buying back their own shares. And I thought, wow, the downside risk here is very low. Like this company is not going to go down 50% unless, sales actually collapse for some reason. And there's a good chance that sales will increase. And sure enough, the campaign was a success. When they had their next earnings call, they talked about how much attention it was getting, and it's actually bringing people into the stores, and their sales were up, the profits were up. Um, and, and basically, I sold half of my position at that point because in that particular instance, even though I'm a long term investor, it did seem like an opportunity that in an area that I don't have a lot of expertise in, that I went in on. I happened to be right, but I was like, I don't know how long I'm going to be right for because the Sydney Sweeney thing had,
Right.
basically stopped being a thing. Their next ad campaign did not nearly get as much attention with uh, Taylor Swift's husband, who's
Travis
Kevin with
Kelsey.
Travis Kelsey. Thank you. I'm like so terrible with the names, but then I was like, okay, well, I don't know how well they're going to continue to do, and now their price earnings ratios and things are well above everybody else in the retail industry. So it
Still
just
going.
feels like again, relatively speaking, it just
Uh,
seems overvalued, right? Now,
yeah,
Lululemon seemed kind of more interesting to me, but and I am a customer of Lululemon, but it's not founder run, so I was not. I haven't jumped into that one.
I will tell you there is a reason it is no longer founder run. Interesting
Yeah.
story, which I won't go into on here, but I did learn the background about why the founder of Lululemon is no longer with the company. It's an interesting one. But yeah, Lululemon trades now at 14.43 PE versus AEO, which is up to 23.24. So it is,
Yeah.
like you said, more than doubled that price earnings ratio. Okay, very, very interesting. And then one kind of follow-up question. So in addition to saying, hey, I want everyone to see my portfolio, you've also really dove into the earnings space and built out earnings hub. People can find all types of information. How important are earnings reports to your style of investing? And are there specific metrics that you look at within earnings reports? Is it, hey, I want to see consistent beats on revenue or something deeper than that?
So fundamentally, for me, every company's eventual success is all about earnings, right? Because if you don't have revenue and profits, then you don't have a company. And so, I'm always surprised at the number of people who invest based on sentiment or based on charts or based on 50-day moving averages or 200-day moving averages. I don't understand any of those things, and there's no reason to understand, in my view, any of those things because fundamentally it comes down to earnings. Earnings is king when it comes down to long-term long-term growth of a company and its valuation because um, what's the reason that Microsoft is trading at $4 trillion today versus a $10 billion company in 1990 or whatever? Well, it's because its revenues have grown. It's because its profits have grown. That's the only reason, right? That's literally no other reason other than revenue growth and profit growth. So you just simply cannot get there. You cannot get there in the long term. Maybe short term you can because of hype or there's a lot of people talking about a particular stock, but long term it has to be about earnings and revenues and profits. Um, so I look at that all the time. I look at every company that I invest in, their revenues, their earnings. I listen to the founders or the CEOs of the company, the CFOs talk about them on earnings calls. And unfortunately, earnings related information seems to be secondary everywhere else on the internet. Meaning, if you go to any financial website, well, sure, you get the stock price and the history, and they give you all kinds of chart type of information, but you don't get, uh, what's the revenue growth look like? What does their profits look like? You don't get that information front and center. You always have to dig for it. You certainly don't get to listen to the earnings calls on most websites. So I wanted to provide that information mainly for myself in a single place. And then, of course, it's useful to anybody else who starts to think about investments from a long term perspective. So that's why we built Earnings Hub. And sure enough, it's been a huge success. It now has hundreds of thousands of users that use it every earnings season. It's pretty cool.
I
And
love it.
and, and in terms of what I look for, it's not necessarily whether or not they beat expectations. It's all about whether or not they're continuing to grow, or at least they're hitting the targets that management was expecting. And that's far more important. Even if they miss, but they're still growing revenues rapidly, right? Like in fast growing companies, like let's say Robinhood or um, Rocket Lab or whatever, if they have a miss, but from expectations, but they only grew 35% instead of 40%, that's not a bad thing necessarily. So I don't necessarily view that as a bad thing, even if the market does. And if the market like has a huge drop because they missed, their revenue targets by 5%, but it was still up 35. Well, as long as there's good reason for it, and I don't think that their growth is done here, then that might create buying opportunities actually. So um, that happened, for example, this last earnings with Meta, where
Right.
uh, you know, for whatever reason, the market decided that after their earnings release that they were going to punish them, and I was like, wow, this now you can buy Meta for a price earnings ratio of 20, and it's growing faster than it has been for years, and it's growing faster than Google and Apple and Microsoft. So at a price earnings ratio that is 35% lower than those three in particular. So, on a relative basis, Meta seems to be a much better investment than Microsoft or Google or Apple.
Right. And you have 10% of your portfolio in it. So
That's right.
putting the money where the mouth is. Really, really, really enjoyed all this. Want to kind of wrap it up in, if you had, one last piece of advice or mantra or mentality that you would imbue into retail investors as they're going through this journey, trying to create long-term wealth, trying to have patience, what would be that final message to them?
Well, I'll caveat it with that I'm not a financial advisor, so
No,
like
not financial advice.
but but
Just general advice, not financial advice.
but I have like internalized the advice that people like Warren Buffett have. Warren Buffett, by the way, is one of my all-time favorite investors, and he has a quote for nearly everything, which
Oh,
is one of the things that sort of growing up, and if you do talk to a financial advisor, they'll tell you is like diversification is king, blah blah blah. But and they end up investing your money in the S&P, maybe divided up into some bonds, maybe some mutual funds. If you want some foreign exposure, they'll buy index or mutual funds that are doing foreign investment, and your money ends up being in literally maybe 1,000 different companies if in order to get diversification. And what that does is it reduces the downside potential for your investment, but it also caps the upside potential to whatever kind of the market tends to be doing. And if you're trying to build wealth, meaning like if you're investing tens of thousands to hundreds of thousands of dollars over the course of, let's say, the next 10 years, and you're hoping that that money will eventually become, in the next 20 years, will become maybe $1 million or more, then you cannot get there with that type of investment strategy, right? And this is something that I did not understand when I was younger, and I should have been much more concentrated. I eventually did become very concentrated investor, but the idea is that you can build wealth through concentration of investments, meaning invest in three, four, five things, um, just to be a little bit more diversified than just investing in one thing. um, but then as the investment balloons, and if you're right and it actually becomes wealth, then you could sort of gradually diversify it more. Now, the way in which I try to achieve now I have, let's say, wealth to my levels or whatever, my standards, to sort of ensure that I don't completely lose my wealth. Well, I have a significant cash position, right? That's why 30% of my position is in cash, but it's also opportunistic, meaning like if I thought that the market was severely under valued today, my cash position might go down to 5% or 10%. But currently, I think that the market might be kind of hot, and maybe it's mostly overvalued, and therefore I have a larger chunk in cash than I do um, under an undervalued market scenario. And the cash position helps sort of cushion the bounces, right?
yeah.
My upside could have been significantly higher if I was like all in, as opposed to not, holding some cash reserves, or if even if I was using margin, that would be even higher potential returns. But I do not recommend margin at all. It's just way too high risk, and margin ends up causing, if you're wrong in the short term, especially, it can cost you by being forced to sell something at the lowest point when it's the best time to be buying it, just to cover margin call. So I don't recommend margin as well. So those are, just like some rough high level things. Concentration helps build wealth. uh, don't be afraid. Like, I'm not afraid of concentrated investments and bets, and then use cash as a way to cushion falls, and be opportunistic by having large cash reserves. And yeah, so that I think covers it.
I think those are great, strong guiding principles. I encourage everybody to go check out. So this is my final question is just, you put out a lot of content yourself. You have a podcast, you've got your page. Just where's the best place for people to find and follow along with your investing journey?
Obviously, Savvy Trader is probably the best place, and you can, if you're on X, there's a link to my portfolio on my X profile, and um, so it's Hamid S. And then there's a link to my portfolio, and it's actually free to subscribe to my portfolio. I wanted it to make sure that I'm dog fooding the product and making it free so that other people can see how it works and kind of get exposure to it before they have to subscribe to somebody who is a paid portfolio. But you can subscribe to my portfolio for free. You can get notifications every time I make a trade. You can see exactly what I own. You can see a history of my trades, and you can see exactly when my portfolio has gone down. And there have been times when my portfolio was down 25-30%. I think in April it was down quite a bit, like because of the uh, tariff things. And you can see as it went down, I was buying in April, like when the tariff announcements were made, and some of the stocks that I loved really took a dive. I ended up utilizing some of my cash to buy at that point in time. And as it recovered, I sold some of that extra that I had bought, because it was more opportunistic, right? But yeah, you can see all of that in real time, and in the future you can get notifications of my trades as well.
Perfect. I think it gives people a lot to go off of here. I hope everybody took a bunch away from this, a little bit on the thoughts of patience, concentration, 10Xs, founder-led companies, right? A lot of great pieces of advice. Make sure that you're checking out Hamid on social media. That's going to do it for this episode of the Wolf Financial Podcast. Looking forward to seeing everyone on the next one. Take care.
Awesome. Thanks, Wolf. Take care.